For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Less than 3 weeks ago, one of the most critical financial data releases of the first quarter took place, and many investors may not have noticed. Amid the overwhelming number of earnings reports and economic data releases, February 14th marked an essential deadline for institutional investors overseeing at least $100 million in managed assets. This deadline required them to submit Form 13F to the Securities and Exchange Commission, providing a detailed breakdown of their stock holdings. This form serves as an invaluable tool for investors, offering a behind-the-scenes glimpse into the buying and selling activity of Wall Street's most influential money managers. While these filings offer broad insights into market trends, they are especially revealing in fast-growing industries such as artificial intelligence. The artificial intelligence sector has become one of the most closely watched areas in finance, and some of the biggest names in investing have been making notable moves in this space. One billionaire investor who has not shied away from shifting his artificial intelligence stock holdings is Stanley Druckenmiller, who oversees the Duquesne family office. As of the end of 2024, Duquesne family office managed over $3.7 billion in assets, spread across 78 different holdings. Unlike some funds that prefer a long-term buy-and-hold approach, Duquesne operates with a highly active strategy, where the average holding period for its investments is less than 7 months. This fast-paced trading style reflects the firm's adaptability in capitalizing on market trends and making strategic shifts when necessary. Druckenmiller's frequent trading activity was especially noticeable last year when he decided to significantly reduce his exposure to some of the most well-known artificial intelligence stocks. Among the most surprising moves was his decision to sell off shares of two of the sector's biggest names, Nvidia and Palantir Technologies. These companies have been at the forefront of artificial intelligence innovation, making his decision to reduce exposure particularly noteworthy. While selling these high-performing stocks, Druckenmiller was simultaneously redirecting capital into what has now become his favorite artificial intelligence-related investment. At the end of June 2023, Druckenmiller's position in Nvidia, the global leader in graphics processing units, reached a peak of 9,500,750 shares. Over the course of 12 months leading up to June 30th, 2024, Druckenmiller completely exited this position, selling all of his Nvidia shares. Meanwhile, Druckenmiller's fund held 769,965 shares of Palantir at the end of March 2024. By December 31st, only 41,710 shares remained, meaning he had liquidated approximately 95% of his position into the artificial intelligence software company. Given how dominant both Nvidia and Palantir have been in the artificial intelligence industry, this massive sell-off raises important questions about Druckenmiller's perspective on the future of the sector. Even though both Nvidia and Palantir possess strong competitive advantages and lead their respective markets, there are several possible reasons behind Druckenmiller's decision to scale back his holdings in these companies. The first and most obvious reason is that Druckenmiller is taking profits after significant gains. Both Nvidia and Palantir have experienced dramatic price increases, and since Duquesne Family Office is a highly active hedge fund, it frequently adjusts its positions to maximize gains. Given the rapid appreciation of these stocks, it makes sense that Druckenmiller would capitalize on these gains and redeploy his capital elsewhere. However, there could be deeper reasons beyond simply locking in profits. Druckenmiller's actions may indicate growing concerns that the artificial intelligence sector is in the early stages of a market bubble. Artificial intelligence is still in its infancy, and businesses are only beginning to grasp how to fully integrate and optimize these technologies for long-term profitability. Many companies are pouring resources into artificial intelligence development, but the challenge remains: how can businesses generate a reliable return on investment from these efforts? Until artificial intelligence companies demonstrate consistent and scalable revenue generation, concerns about a potential market bubble will persist. In an interview with CNBC in May 2024, Druckenmiller drew an interesting comparison between the early days of the internet and the current artificial intelligence boom. He pointed out that while the internet turned out to be an even bigger force than people expected in 1999, it took many years for the technology to mature and become the global powerhouse it is today. Druckenmiller noted that artificial intelligence may currently be overhyped in the short term, but could be underestimated in the long term. Another major factor that may have influenced Druckenmiller's decision to sell Nvidia and Palantir is their historically high valuations. In the summer of 2024, Nvidia's price-to-sales ratio soared to 42, while Palantir's surge to $125 per share pushed its price-to-sales ratio to an astounding 99. During the dot-com bubble, leading technology companies reached price-to-sales ratios in the range of 30 to 40 before their stock prices collapsed, leading to losses of 80 to 90%. While it is unlikely that Nvidia and Palantir will experience declines of this magnitude, history has repeatedly shown that such extreme valuations are rarely sustainable over the long run. While Druckenmiller has been reducing his exposure to Nvidia and Palantir, he's been making a substantial investment in Amazon. According to Duquesne Family Office's latest Form 13F filing, the fund purchased 328,400 shares of Amazon during the December-ended quarter. This acquisition makes Amazon the 11th largest holding in the fund by market value and the top artificial intelligence investment in Druckenmiller's portfolio. Amazon is widely known for its dominance in e-commerce, with estimates from eMarketer projecting that the company will account for more than 40% of all online retail sales in the United States this year. While online retail represents a significant portion of Amazon's total revenue, this segment operates with lower profit margins and is not the primary driver of the company's cash flow or earnings. Instead, the real financial engine behind Amazon's success, and likely a major reason for Druckenmiller's investment, is Amazon Web Services. Amazon Web Services holds a commanding lead in the cloud computing industry, with a 33% share of total cloud service spending in the fourth quarter based on estimates from Canalys. Businesses are still in the early stages of increasing their cloud-related expenditures, and the integration of artificial intelligence solutions, including generative artificial intelligence, into Amazon Web Services is expected to drive even greater investment in this sector. By the end of 2024, Amazon Web Services was generating over $115 billion in annualized revenue, with its growth rate accelerating to nearly 20% on a constant currency basis. While Amazon Web Services accounted for less than 17% of Amazon's total revenue last year, it contributed 58% of the company's operating income. These strong profit margins will likely enable Amazon's cash flow to expand significantly faster than its revenue in the years ahead. Druckenmiller may also see additional opportunities in Amazon beyond cloud computing. The company has made strategic investments in entertainment, securing exclusive rights to stream Thursday Night Football along with a package of National Basketball Association games. As Amazon's library of content expands, its subscription services, including its Prime membership program and advertising revenue, are expected to see substantial growth. Finally, Amazon's valuation may have been another major factor influencing Druckenmiller's investment decision. While the company may not appear cheap by traditional financial metrics, its price-to-cash flow ratio is historically low. Historically, investors typically purchased Amazon stock at a median multiple of 30 times year-end cash flow. At present, shares are trading at less than 13 times the forecasted cash flow for 2026, making it an attractive investment opportunity. In the end, Stanley Druckenmiller's Duquesne Family Office recently made significant changes to its artificial intelligence stock holdings, selling off its entire Nvidia position and reducing its Palantir stake by 95%. While both companies are industry leaders, Druckenmiller's moves suggest concerns over high valuations and a potential artificial intelligence market bubble. He compared the artificial intelligence boom to the early internet era, stating that while it may be overhyped in the short term, its long-term potential is underestimated. Instead, he's been increasing his investment in Amazon, purchasing over 328,000 shares in the latest quarter. With Amazon Web Services contributing significantly to the company's operating income and its valuation appearing historically attractive, Druckenmiller sees it as a better long-term investment. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.